Manar, welcome to The Art of Boring.
Thanks, Rob. It was a pleasure. Thanks for having me.
Well, I should say welcome back because I think you know this, but one of my favorite podcasts from last year was when you came on to talk about the art and science around position sizing. And if you missed it, listener, go back and check it out. Episode 151. We spent 40 minutes on this topic and it was just fascinating stuff. But from what I remember, Manar, a portion of our discussion was devoted to, well, what do you do with position sizing when stock prices move a lot? And you had shared a number of frameworks and base rates to help guide decision-making in those types of volatile environments. And you can probably see where I'm going with this. We've seen a lot of volatility in markets so far this year, and especially over the past month. A lot of it negative, but also some real upside volatility too. And I'd love to spend our time together today just walking through, a number of instances in the portfolio where stock prices have moved around and just understand how you and the global equity team have been dealing with the volatility. Does that sound good?
That sounds great.
Perfect. Well, let's start, I guess, more generally. The last couple of weeks, maybe a month and a half of just trade policy and the volatility that has brought into the market. Just your general thoughts on the current moment.
Yeah, highly applicable. I'm glad to did kind of a detailed deep dive into position sizing today. I was half joking with the team that ChatGPT has changed the world, but not in the way the world may have thought. And, there was some speculation that the tariffs were calculated, the so-called reciprocal tariffs were calculated using ChatGPT as kind of a basic methodology, and that's kind of reverberated across the globe. I think that the nature of the calculation is interesting in itself because it's focused on the trade deficit versus the actual tariff rates that are put on from the countries to the U.S. And that's interesting because some countries are structurally have trade surpluses given the U.S. is sort of the consumer of the world. And, Rob, I have a trade deficit with my local Walmart, right? So that's not necessarily a bad thing because, I'm purchasing my groceries from them. So not all trade is bad. It's not a zero-sum game, but it does feel that way through the calculation. And that creates problems for management teams that are quite significant because during Trump 1.0, for example, a lot of CEOs began mitigating their production away from China into other countries like Vietnam. And just to see sort of a higher tariff on this poster board, like the ones I used to do in elementary school to some degree. And that uncertainty has fed into decision making where there's a mismatch between long-term commitments of capital expenditure and the uncertainty of the regulatory regime. Why spend money if in 5 minutes later or a tweet later the whole tariff complex is going to change?
Yeah, so it sounds like you're seeing real hesitation in your conversations the last couple of weeks with management teams with respect to the deployment of capital.
Absolutely, and I think that there's not been a lot of places to hide given the nature of the tariffs, kind of pretty broad-based. But also, if you think about long-term capital commitments relative to, let's say you want to reshore manufacturing, but if they're going to keep changing kind of constantly, it's hard to make that decision. And so that whole pause reminds me of some type of supply shock like you'd see in COVID where we had lockdowns in the pandemic. And the escalations have some reflexive element, which we've seen in China and the US. Now, there are some optionalities, Rob, in the reversals of policy. Right, there's an option that you have there because you can kind of reverse it. But I do think the greater likelihood that there is damage that's harder to reverse.
Yeah. Can we talk about the global strategy itself, global equity? Obviously, in the type of environment that we've had, there have been some positions that have moved down significantly. Can you talk a bit about where we've had perhaps more exposure to trade policy within the portfolio?
Yeah, and just linking this back to position sizing, I think the whole Trump oscillation and whipsaw, so to speak, is a good example of the futility of trading too much on news flow. It's kind of like a great sample that's happening in warp speed. And the question is really the present value of all future cash flow swinging by 5 to 10% every few hours. And so there's a lot of complexity and futility of sort of in the macro prediction. But we own an apparel company that sources significantly from Vietnam, for example, and Cambodia. The impact of the tariffs obviously are direct on the cost of goods sold. But there's also second order effects on the consumer, which is if there's, inflation that erodes the purchasing power, elasticity of the consumer towards this discretionary. But, the apparel company we own, we feel has strong relative scale advantages. The key, Rob, is that it's happening to all its competitors. Most apparel companies are producing in those areas of China, Vietnam, Cambodia, Sri Lanka, and Bangladesh, for example. And so as long as that's being applied kind of evenly across, then we would expect the players with the relative scale advantages to win in that environment.
So you're saying that the competitive dynamics between companies, the apparel companies, doesn't change that much. But what about the just like, hey, every American is going to have to pay more for their leggings?
Yeah, certainly. I think that every American would have to probably pay more. Now, this will depend on the pricing power of the business. Now, it's not as significant when you look at it, on a cost of goods sold basis, because this business has really high gross margins, and as a result, 10% pricing is required roughly to protect the profit on a dollar basis. And so that would be $10 on a $100 item. Again, not great, but not terrible. Certainly there might be some elasticity, but you can imagine there are certain players within this industry that have been growing really quickly, kind of peers or competitors, but they've been spending all these investment dollars and they have lower profitability to be able to withstand that kind of this degree of tariffs. And so I suspect that they'll have to grow a lot slower, reduce their investment dollars, and exit the industry potentially, or really reduce that. And then we look at ultimately over 5 or 10 years, Rob, whether the underlying generator of decision making for the business is doing good. So in this case, it would be: are they producing new products? Are they continuing to focus on what's in their control? And how robust is their balance sheet? And this is a kind of a net cash business.
So it sounds like, as you mentioned earlier, on the futility of trading, just given, presumably as we record this podcast, things could be changing, but lots of offsets and competitive advantages that remain intact despite a more challenging environment. Hence, hold on. Can I ask you though? You talked about this particular company, but when looking at the portfolio overall, is it fairly representative of the type of exposure that each company might have?
Yeah, this is critical and something we think about a lot, Rob. We have low overall kind of export-based models with direct exposure to tariffs.
Okay, so this particular company would be sort of one of the exceptions in the portfolio versus the rest.
Yes, I wouldn't own a 50 stock portfolio diversified with apparel companies, and so I think that, certainly from an export-based model, we have pretty low direct exposure on a relative basis. And this links directly to position sizing. Like, what is your comfortability in that? And, over time, most stocks will follow their intrinsic value growth, but you want to have robustness within the portfolio. We have a preference, our tendency for asset-light, service-oriented, reoccurring type businesses. Kind of toll road businesses like the insurance brokers, Marsh & McLennan, or Aon, kind of earning capital-light royalty on growing insurance premiums over time. Mostly kind of domestic-based, service-oriented, and certainly on without taking the risk of insurance. Now, the what we're noticing is the second order effects of these tariffs on cyclicality is tending to have a bigger impact. So you have these direct exposure companies; those obviously have been impacted in terms of their stock price, at least directly. But the second order effects also are creating a bigger impact on cyclicality. So this is the idea that, hey, the consumers are going to get hurt. And so consumer discretionary advertising, for example, Publicis, because it's, the largest advertising agency in the world, there has been some perception of second order effects, expectations that the ad market is slowing down. And that's a pretty reasonable expectation, although we do think that Publicis is more resilient and than expected given the mix of the business today, and it's kind of quite a reasonable valuation.
One of the observations that I've had when looking at the portfolio's experience so far this year is that a number of consumer-oriented businesses that we own, despite your point on, hey, there might be some hesitation to spend, a lot of them have done quite well this year on the back of perhaps a more disappointing 2024. And so I'm just curious, what's the anomaly with some of those holdings?
Yeah, I mean, what we're seeing, Rob, is consumer staples had a pretty rough, post-pandemic period. They took a lot of pricing that hit a lot of volumes at the time. And so broadly, some of the consumer staples had kind of margin hits due to the inflation, and they struggled with volumes. Now what we're seeing is kind of a volume recovery in some of the businesses, particularly some of the ones we own, and some normalization in the inflation rate, which allows them to kind of recover their profitability. The interesting part of this here, Rob, for us from a position sizing, a portfolio management perspective, is there's a lot of randomness in the short term. And so imagine you're kind of relying on the short-term price action for your decision making. Well, clearly it's been a bad basis for good, repeatable decisions, because many of those stocks that we're referring to within our portfolio are top performers this year. And so that if we step back, we think about shifting the focus kind of from line items to the whole portfolio. And the idea is that parts of the portfolio is always going to disappoint you all the time, right? So consumer staples last year, maybe big tech this year, and that comes hand in glove with good diversification. But over time, what we're trying to accomplish is if you eliminate all the factors through diversification and principled thinking, we want to end up with a portfolio of businesses. The factors that shine out of that is kind of good business, good management, reasonable prices.
And I would suspect you're seeing management teams make some good decisions. I'm curious if you can talk just to Admiral Group and its experience so far this year.
Yeah, Admiral Group had a tough 2024 as well. So it's a largest UK motor insurance business. The thing with the motor insurance business, you get sort of inflationary pressure on, let's say, the car repairs, for example. And so you might misprice insurance for 1 year. Now, it's a short tail insurance business. So the next year they reprice and capture those trends. So there's a lot of more volatility in the stock that relative to the profitability of the business. But when we look at Admiral, I think it's a very interesting story, Rob, because most property and casualty insurance companies, the industry itself, the base rates are that they don't create wealth. They're not very great businesses because the business is commoditized and capital intensive and typically really, really pressured. A lot of capital chases it on the upcycle. But Admiral has really high persistent returns on equity. And our goal is to figure out what business it's in. It's clearly not necessarily in the P&C insurance business, at least directly. And part of the story here is that Admiral kind of has a competitive advantage in underwriting the insurance premiums, which it then cedes to other insurers. It offloads it to other insurers. So it becomes, in our view, more of a broker because it's ceding the premiums. And so it's much more capital light of a business. As a result of that, we think of it a little bit more as an insurance broker as we're trying to understand why there's a high persistent ROE. And I think that's one mental model we apply is looking at the returns and trying to understand what business is it actually in versus just the base rates of the industry. That's a good starting point. And then you can kind of see if it's the exception to the rule.
Okay. So Admiral Group doing a really good job for the portfolio so far this year. Can I ask about UnitedHealth, which perhaps hasn't? Had a pretty big down day. Was it last week, I think? What's happening with UnitedHealth?
What's interesting, Rob, is again short-term price randomness. It was having a phenomenal year to date. I think it's something that we obviously own businesses for 8 to 10 years, but it's having a pretty phenomenal year to date on a relative basis, in part because it's the largest U.S. healthcare insurer with kind of adjacent businesses, because it's completely vertically integrated. It has a pharmacy benefit manager, and it also has this attractive analytics franchise for health data. But long story short, I mean, it's kind of more defensive. It had already gotten priced to some degree on a risk, in terms of risk premiums coming around from the administration, and so this is not unusual for it. Every 4 years, you have an election cycle, and there's always an increased level of uncertainty around the next administration. Will the U.S. move towards a public, fully public, healthcare system? What UnitedHealth has shown over long periods of time is that the status quo is quite sticky. The business has significant scale advantages, and that allows it to be the most efficient operator. And it's moving towards value-based care. The more logical assessment of UnitedHealth would be the government would want to work with this, because it has the highest scale advantages and the most efficient operation in order to improve care. Now, reminds me of the Admiral. We just talked a little bit about it, Rob. What's happening here is the insurance business, you try to estimate the cost. So in this case, it would be the medical utilization rate. So how many people are coming into the hospitals and your different services, and that can be lumpy and volatile, right? There is an element that you can't predict as well, but it does reprice, and that repricing typically corrects in a kind of a shorter time frame. And that regulatory headwind tends to create volatility, but when we look at the business, it's very wealth creating because it's quite asset light. There's great alignment kind of from a management standpoint, and quite a reasonable valuation, because a lot of that uncertainty is being priced today on the business.
Okay. So, a move like that presumably evokes a lot of emotion, but it sounds like what you and the team are doing are really going back to base rates and recalibrating the odds. It doesn't sound like the odds have changed that much in your assessment.
Yeah, well, our assessment is the odds hasn't changed much within the investment case or the thesis around that. The base rates reminds me, Rob, of in the position sizing podcast, we talked a little bit about revisiting Michael Mabuson's man overboard moment. And in the man overboard moment, the stock is down more than 10% relative to some benchmark, and recalibrating your temperament and your emotion, which is essential. And effectively, you go down the list of kind of the quality, the valuation, the momentum. It's a base rate kind of checklist. And it just allows you to kind of take back control of your own emotion and look at it more rationally.
Manar, some of the big market movements that we're seeing, are they providing opportunities for you and the global team? Are there companies that you wanted to hold? And, the question that we often get is just, hey, US tech, some of these big companies, it's been part of the market that's sold off most precipitously over the last little while. Are you and the team seeing opportunities there? And if not, where are you seeing opportunities at the moment?
Yeah, I'm a big fan of Game of Thrones, Rob. So Peter Baelish in Game of Thrones says, chaos is not a pit, chaos is a ladder. And so certainly I think that some of that chaos can provide some opportunity. I don't know that you want to rush into things directly impacted by the fire. Like, if there's a fire, I'm not sure you want to rush into the fire. But I do think that there is opportunity around things that have sold off just generally due to some cyclicality, temporary hits perhaps to the profitability of the business, but not potentially, permanent impairments in the earnings quality and earnings power of a business. So, we have more recently started, buying the stock around pessimism at that time around the Chinese consumer, particularly. It's a beauty and cosmetics business. It's quite balanced from a revenue exposure. and supply chain perspective, which we like. So very robust. And beauty and cosmetics has been around for more than 7,000 years. Back to the Egyptians and et cetera. So this is quite a durable.
Vanity.
Yeah, vanity is quite a durable trend here, Rob. Now you have to stay with the times. Obviously, it's changed, from in terms of what is being used as beauty and cosmetics. But this is a company that has a lot of scale advantages in distribution and marketing. It spends more than the next few competitors, by a couple of factors. And I think the distribution points and the balanced revenue and supply chain exposure, while it has proved to be pretty fruitful coming into, we try to prepare, not predict. We couldn't have predicted perhaps the degree of these tariffs, but certainly that balanced supply chain exposure was helpful. And the business has a tendency to outperform the beauty market and kind of take share, and it's been capitalizing on a lot of missteps of peers. I think what's important here is that there will be a lot of kind of nascent beauty competitors with the online age. Like you can just launch. Hey, Rob and Manar's, eyeliner on Instagram.
Yeah, you'll be the face of that business, Manar, not me.
I don't think it'll be a very successful business, Rob, unfortunately. But let's imagine we launch an eyeliner business on Instagram. There's not a lot of barriers to entry anymore. It used to be, you needed to have a TV marketing, massive expenditure, but the barriers to scale are massive. So we can launch our eyeliner, on Instagram and get, $50 of sales, but the barriers to scale are massive because you need distribution. You need to get all the distribution points. You need the right supply chain. And if you think of that within the tariff standpoint, you need a balanced manufacturing exposure. Imagine we're sourcing all our eyeliner from China because that's easy drop shipping, and now we're facing 145% tariffs. Effectively. Well, as of today, I don't know if you're watching X or wherever he's going to tweet. So that we try to keep an open mind, have strategic inventory. I think that's the key, Rob. And one of the things is that the generals are always preparing to fight the last war. So there is an element where we're trying not to invest in the present, right? Certain things have really won, perhaps over the last 5 years, but we have to be sharp, and our mental model around that is, what will the next person think in 12 months? So it doesn't necessarily have to be the thing that's won over the last 5 years.
Manar, can we end just would love your thoughts on portfolio behavior. Obviously, it bounced around a lot the last little while, but just how do you assess that looking back over the last couple of months?
We've tried to stay disciplined around the idea that we're long-term business owners of these businesses, and over time, most stocks follow their growth and their intrinsic value, as long as you don't overpay. And so we continue to focus on staying balanced across quality and value. Certain days have had quite notably better downside capture. So that is, kind of consistent with how we would expect the portfolio to sort of move from a behavioral standpoint. And over time, we believe that our portfolio's statistical advantages around valuation, around returns in terms of quality, around our alignment and the insider ownership will reflect in the growth in the intrinsic value. But we can't, kind of coming into this sort of trade war, we were diversified globally, and we continue to do that from a first principles standpoint. Canada, Europe, and across market cap ranges often. So I think we have a solid balance around that from a global equity strategy standpoint. And I think it was Cliff Asness who said something that resonated with me, Rob. The difficulty of doing the right thing should not be an excuse to do the wrong thing. So we'll continue to do the difficult thing, which we think is the right thing, to be diversified, to be balanced, and stick to the philosophy and process. And we trust that will play out over time.
Well, I think the wrong thing, Manar, would be for you and me to have a side gig with an eyeliner company. So let's not do that. But certainly do appreciate your time and insights. As always, love having you on The Art of Boring.
Well, I appreciate it, Rob. It's a good reminder that sometimes the difficult thing is the wrong thing. So yeah, the difficulty of starting an eyeliner business is not what I'm referring to.
Very good. All right. Thanks, Manar.
Cheers. Thank you.